Imagine earning an extra $500 a month without even leaving your couch. What if I told you that you can become your own bank, lending money directly to others and earning interest on each deal? Welcome to the world of peer-to-peer lending. This isn't just for the financial elite. It's a side hustle accessible to anyone with a bit of cash and a desire to grow it. Stick around, because I'm breaking down exactly how you can start generating consistent passive income with peer-to-peer lending today. So what exactly is peer-to-peer lending? It's a financial framework where you, as an individual, lend money directly to borrowers through online platforms, bypassing traditional financial institutions like banks. Think of it as matching people who need a loan with people who have money to invest. The kicker? You earn interest on the money you lend, just like the banks do. It's a win-win. Borrowers often get better interest rates than they would from a bank, and lenders, like you, get the chance to earn steady returns on your investment. The beauty of peer-to-peer lending lies in its democratization of finance. The barrier to entry is low, allowing anyone with some extra cash to participate. Unlike traditional banks, which require substantial capital and stringent qualifications, P2P lending platforms are accessible and user-friendly. You'd be surprised at how even small amounts can be put to work in this financial ecosystem. Now, you might be wondering, isn't this risky? And sure, just like any investment, there's risk involved. However, peer-to-peer lending platforms offer various tools to mitigate these risks. They use advanced algorithms and data analysis to evaluate borrower creditworthiness, providing you with detailed information to make informed decisions. Additionally, many platforms have built-in features like reserve funds or insurance to protect lenders from defaults, making peer-to-peer lending a calculated risk with potentially high rewards. The first step in your peer-to-peer lending journey is selecting the right platform. There are several reputable ones out there, each with its unique features, fees, and borrower profiles. Some popular platforms include Lending Club, Prosper, and Funding Circle. Each platform offers different types of loans, ranging from personal loans to business or real estate loans, and caters to various risk appetites. When choosing a platform, look for those with a solid track record, transparent fee structures, and robust borrower vetting processes. Some platforms charge service fees or take a percentage of your earnings, so understanding their fee schedules is crucial. Also, check if the platform provides detailed borrower information, such as credit scores, loan purposes, and payment histories, to help you assess potential risks. When signing up, you'll usually need to provide basic personal information and link a bank account for transfers. Most platforms have low entry barriers, with minimum investments often starting as low as $25, so you don't need a fortune to get started. However, if you're aiming for that $500 a month, consider a larger balanced portfolio. Some platforms offer auto-investment tools that allow you to set your risk preferences and automatically reinvest your earnings. This feature is particularly useful for beginners or those who prefer a hands-off approach. In peer-to-peer lending, understanding the balance between risk and reward is crucial. Each borrower will have a credit profile and risk rating. Generally, higher-risk borrowers pay higher interest rates, which means more potential income for you, but also a greater chance they might default. Conversely, lower-risk borrowers offer more security but with lower returns. Diversification is your best friend here. Instead of putting all your money into one loan, spread it across multiple loans with varying risk levels. This way, if one borrower defaults, it'll only impact a small portion of your portfolio. Many platforms allow you to invest in small increments across different loans, which is a great way to manage risk. Moreover, some platforms offer risk assessment tools that categorize loans into grades or tiers based on the borrower's creditworthiness. By understanding these ratings, you can create a diversified portfolio that aligns with your risk tolerance. For instance, mixing high-grade, lower-yield loans with a few riskier, higher-yield loans can create a balanced strategy that maximizes returns while minimizing risk. It's also important to stay informed about economic conditions and trends that might impact borrowers' ability to repay. For example, during economic downturns, default rates may increase. Being aware of these factors can help you adjust your strategy and protect your investments. To build a successful lending portfolio, focus on 3 key strategies: diversification, reinvestment, and monitoring. As we've discussed, diversification helps spread risk, but reinvestment is where the magic happens. As borrowers repay you with interest, reinvesting those funds into new loans boosts your earning potential exponentially. This is the power of compound interest at work. Monitoring your portfolio is also critical. Keep an eye on the performance of your loans and adjust your strategy if needed. Some platforms provide alerts if a borrower is late on a payment or their creditworthiness changes. Using this information, you can reallocate your funds to optimize returns. Regularly reviewing your portfolio ensures that you're not only earning interest, but also maintaining a healthy mix of loans. A practical tip for reinvestment: set a schedule to review and reinvest your earnings, such as monthly or quarterly. This habit ensures that your money is continuously working for you, rather than sitting idle. Also, consider setting aside a portion of your returns as a reserve fund, which can be used to cover potential losses or reinvest during favorable market conditions. Lastly, stay engaged with the P2P lending community. Many platforms have forums or user groups where investors share insights, strategies, and experiences. Learning from others can provide valuable perspectives and help you refine your approach over time. Like any income-generating activity, there are tax implications to consider with peer-to-peer lending. Earnings from interest are typically considered taxable income, so you'll need to report them on your tax return. Many platforms provide detailed tax reports that make it easier to understand what you owe. In the US, for instance, interest income from P2P lending is generally taxed as ordinary income. This means the tax rate you pay will depend on your overall income and tax bracket. It's important to set aside a portion of your earnings to cover these taxes, so they don't catch you by surprise. It's also worth consulting with a tax professional to understand how peer-to-peer lending fits into your overall tax picture. This can help ensure you're maximizing your deductions while staying compliant with tax laws. For example, you might be able to deduct certain expenses related to your investment activities, such as platform fees or legal advice. Consider using tax software or services that integrate with P2P platforms, streamlining the process of tracking and reporting your earnings. Staying organized and informed about tax liabilities not only helps you avoid penalties, but also allows you to focus more on growing your investment portfolio. Let's talk about real success stories. One user started with just $1,000 and, by consistently reinvesting his returns, grew his portfolio to over $20,000 in a few years, netting over $500 a month in interest. His secret? Patience, diversification, and a keen eye on risk. Another user focused on a niche market, lending to small businesses and startups. By leveraging his knowledge of the industry, he was able to identify high-potential borrowers and negotiate favorable terms. This strategy not only provided him with higher returns, but also contributed to the growth of businesses he believed in. A tip from seasoned investors: use platforms that offer secondary markets. These allow you to sell your loan parts if you need quick liquidity, adding another layer of flexibility to your investment. This feature can be particularly useful if you anticipate needing cash before a loan matures or wish to exit a position due to changing market conditions. Always keep learning and adapting your strategy based on market conditions and your personal financial goals. Engage with online forums, attend webinars, and read up on the latest trends in P2P lending to stay ahead of the curve. Continuous education and adaptation are key to long-term success in this dynamic field. So there you have it, the ins and outs of peer-to-peer lending as a powerful side hustle. Whether you're just getting started or looking to refine your strategy, there's plenty of opportunity to earn substantial passive income from the comfort of your own home. If you found this video helpful, hit that subscribe button for more savvy side hustle insights, and let me know in the comments, what's your biggest concern about starting peer-to-peer lending? Let's chat about it.